There are hundreds of smart money concept videos on YouTube, guys, but they don't actually show you why these concepts work in trading. They don't show you the actual framework behind these concepts. They just show you how to draw an order block or a fair value gap, or they just show you some technical jargon and they just call it a day. You can see right here, we got a ton of creators, man, showing how smart money concepts work, just drawing this up, but they're not really explaining why it works. But more so, I mean, I haven't really watched the videos myself, but have they even shown you verified prop firm payouts? That's the biggest thing, guys, right? The reason I know these concepts work, and I've been using these concepts for my whole trading career, is because I've actually gotten verified prop firm payouts with these concepts, guys, and you can see them for yourself. By the end of this video, you're not just going to know the terminology, you're going to understand how liquidity works, the whole framework behind it, and the reason why price even moves in the first place. It took me a very long time to make this video, guys, so we're going to be going fully in depth as usual with this new style, so please drop a like and let's get into it. Before I even teach you guys a single concept in this video, you first have to understand how price even moves in the first place. All of this is driven by liquidity. So every single move you see in the market, right? You see some type of crazy, high or low being made, a crazy pump, or, a crazy dump. All of this is driven by institutional algorithms and institutional players engineering liquidity to load their positions. The price is not moving because of just random patterns. It's moving based off the order book, and it's moving based off this idea that institutions, if they want to get into a position, if they want to get into a trade, they first need to fill their orders at the most optimal price. Because think about it, you need liquidity to fill your massive orders, because if you don't have an optimal amount of money or an optimal entry, well, you're just going to get traded into and you're not going to really have a good point to buy or sell. I wanted to give you an example like this, right? Let's say you have a 10,000 shares of a stock, okay? You are going to need buyers. And where are the buyers? Like, let's say not even 10,000 shares, 10,000 contracts, right? You're going to need buyers, right? If you don't have 10,000 people to buy your contracts, well, price is not going to move. You're not going to get where you want. You're not going to get into the market where you want to get into it. And if anything, you're going to get traded against, and it's going to go in the opposite direction. So that begs the question, where are the buyers sitting? Okay. And the sellers, where are they sitting? Because if I wanted to buy, 10,000 contracts, right? I'm going to probably buy where everyone is selling. And this is the whole idea of liquidity inducement theory. So again, the price moves because of liquidity. And this is the first misconception, right? Retail thinks that support and resistance is, how the market moves, but that's not the case. Well, yes, supply and demand is the real name for it. Support and resistance are just, I would say, just variations of the term to mean the same thing with an actual, instead of, well, okay, let me take it a step back, right? Supply and demand is going to be like drawing like a box around a region, while support and resistance is going to be just like a straight line at a price level. But the reality is, we know liquidity, and the reason is because of what I just said, right? Retail, what they're doing is think about all the retail people. They're just drawing lines, okay? They're drawing lines and they're hoping that price bounces off those lines. But then in reality, since we know the market really moves on liquidity, the price is going to move to fill the large orders first, and the algorithms are then going to spool price into in the opposite or continuing direction using the algorithms. And this is a known fact, guys. You have these optimization algorithms to, unload their huge block orders, and this is a known fact. Every concept that I'm about to explain in this video is talking about where to identify where liquidity sits. It's going to be a variation of just figuring out, where this liquidity is and how you can take advantage of it. Like I said, the key here, right, the key in this whole diagram that I've made for you guys is that the large players, the banks, institutions, macro-based funds, discretionary funds, they are going to need liquidity to enter into the market, right? And like that analogy I give you of the 10,000 contracts analogy, you want to get in where everybody is doing the opposite thing. Because if everyone is doing the opposite thing of where you want to get in, you've engineered that amount of money for yourself to then move price in a certain direction. And where they do this at everyone's stop losses. But you're probably asking, like, okay, if this is the question and this is what I've said, where are people's stop losses? And this is why I want to bring to your attention these two terms, all right? These two terms you've probably heard in ICT trading, smart money concepts trading, but it's called buy side liquidity and sell side liquidity. All right. For buy side liquidity, this means you have stop losses resting above swing highs. These are resting buy orders. All right. And, we're going to get into a full example, a diagram that I've made for you guys. but also, it gets a little bit more complex than this. I'm just really trying to show you like a rudimentary example and trying to, for my beginners out there, really, drive home this point. But, for a later video, we might get into like into like advanced order book dynamics on how buy stops work, sell stops work, advanced order, mechanics, etc. Because you do also really need to know that if you really, like this video and you really want to go in depth. But simply put, right, these are just stop losses that are resting above swing high order or swing highs, right, which are going to be resting buy orders. And for sell side liquidity, there's going to be stop losses resting below swing lows, right? And again, we're going to get into this diagram over here real quick. But like I said, every concept in this video is just going to be a way to show you where the liquidity sits and how these institutions are, grabbing it and utilizing it to get into their positions, but then how you can leverage that for yourself based on oh my god, I can't even speak, based on what I'm about to teach you guys. Which brings us to this example. All right, this is where liquidity pools form at swing highs and swing lows. Now, it can get a little bit more complex than this again, but I'm just trying to show you a rudimentary example because technically this is how the market works. You can see right here, right, we have this swing high being formed here, a swing low being formed here, and then another swing high being formed here. We also have a swing low here and a swing low here. Now, you probably, if you watch ICT videos, you've probably seen the term and looked at the term relative equal highs and relative equal lows, where price needs to sweep to get towards. But in general, it's just every swing high and swing low. I don't want you to put an emphasis on just equal highs and equal lows, right? I don't want you to think that, oh, it's something like this, and then we have equal highs like that. It's just every single swing high and swing low in general, because it's a little bit more, there's more variations to this, right? But in general, what's happening is that at these swing highs, right, let's say someone's trying to sell. They sell right here, right? They're putting their stop loss above these swing highs like this. And then what happens is that you'll notice a lot of the times that price will push up to these, these areas, these swing highs and swing lows, these general areas, this density of orders, and then end up having a move down or up. And you can see in this case, we're not highlighting that point right now, but I'm just going to show you where the sellers in this case are putting their stops, right? If you're selling right in this area, right, intraday, if you're selling here, well, you're selling somewhere along this leg, somewhere in this area, and your stop losses are going to be in this area right here, like this. If you're buying, right, and this is called buy side, remember, buy side liquidity. If you're buying, right, same analogy, right, you're buying somewhere around here, and your stop loss is going to be in this area, right, somewhere in this area, and this is called sell side. Your buyers are placing stop losses below the swing lows. And yeah, that's just how the orders are working, how retail traders and in general, even other funds and other macro-based funds, just people who are trading the markets are trading. But the reality is, guys, is the institutions need the liquidity to fill the orders. Because I want you to think about it like this, right? Like if you know that there's people selling above this high, well, why wouldn't you want to put your orders above where most of the people are selling? Because it's the most optimal point for you to get filled in on your contracts. So it would be reasonable to assume that you can target the sellers, right? Buy up to the sellers, and then as you're buying up to the sellers, you're filling your sell orders along this whole move to get an optimal price. And once you hit that swing high, then you start pushing price down in your direction. This is what the institutions do. They're going to target the stop losses cluttered at these swing highs and swing lows. So now that you've understood the concept of liquidity and how liquidity works, how it's engineered, where people are putting their stops, right? We're going to be talking about this concept called the AMD cycle. It's called accumulation, manipulation, and distribution. It's essentially a version, not a version, but essentially a understanding of this concept of how institutions are taking advantage of liquidity to then move price in a certain direction. Because you'll see these interactions happen at, even the granular, 1 minute level. This interaction is always happening, right? You'll see price hit swing highs and swing lows, have a reaction, and end up selling off or going higher, right? And this is just in general how the order book works. This is just an overall, in general diagram that I've made. But specifically what these institutions are doing is they're using something called the AMD cycle, of where they're essentially waiting for price to consolidate, where there's a huge range, right? In this range, orders are going to essentially stack up, and retail gets comfortable. You can see here from this example over here, from this example, you can see it's basically the same thing, right? We have the kind of these highs and lows being formed, this range being formed, right? But then what they do is then they manipulate that range. Why? Because all of those people, like I said in this example, they're selling, they're buying right below here, right? So all the people in this range, they're buying. All these stops are going to be below this range, below this low. And don't worry, we're going to do also real chart examples. So what people are going to do is the institutions, they're going to manipulate that price action of where they run the stops, right? They're going to push price lower below this range where all the sell orders, the people who are buying, where all their sell stops are going to be, they're going to hit all those sell stops. And then that's going to cause a cascading effect of where then they can buy and then push price all the way up. You know this as a liquidity sweep. All these stops right in this range over here are getting taken out, all these retail based stops. And then that's when they want to distribute price, right? The real move starts when the institutions are positioned and then price reaches its target, right? They want to push price to here. It would be smart to sell to a certain level where there's enough liquidity to fill their positions and then push price up. And this repeats on every single time frame, every asset, every session. And you just need to get an idea of how you can utilize this and get a picture of it in your brain so then you can take advantage of it. So I just want to show you an example of this on the chart so you can kind of get a feel for how these order book interactions work, right? So for example, all right, in this case, you're seeing that, you can see our swing highs and swing lows. And I just want you to just get a bare picture of what happens when we take a look and we see these swing highs and swing lows, right? So for example, let's say we have a swing high right here. You can see what happens, right? We take out that swing high and then price just ends up dumping, right? Now, obviously, this wasn't like a full-on reversal, right? It gets, again, more complex than that. But you're seeing the idea of how this interaction works, right? In this whole swing leg, right? If I mark out this whole swing leg like this, well, you can see obviously that price originates over here, right? It originates over here. It's making this whole leg down. The origins of these orders are going to be right here. This is that swing high. And look what happens. We hit that high, right? Institutions start to accumulate all of their sell orders to start selling because why? Because look what happens, right? This is where everyone was selling originally, right? So we trade back up to it, we generate that liquidity, we trade back up to it, and then they start selling again, and they push price down. Now, this is also because of Trump and a fundamental catalyst coming in. But if you go on the lower time frame and just look a little bit more granular as well, you can see what's going on, right? You see this high get taken out, right? It sweeps it, it takes it out, has a reversal, retrace, ends up going down. This is a great example as well of our AMD cycle, right? You can see on a generalized time frame what happens, right? We have our range being formed, right? We have our range like this that's formed, a consolidating range. We push up from that range, right? Hitting everyone's sell order, their buy stops, right? All their stop losses are getting hit, and then guess what happens? We push price down all the way like this, and then this is the whole AMD cycle, right? This is our accumulation. This is going to be our manipulation, and then this is going to be our distribution. And again, these trades will take some time to play out, right? But you can see this distribution wasn't just this small move like this, like all of this. This wasn't the distribution. The distribution was this whole move, and you can see this ran from March 3rd to March 22nd. So damn near 19 days of price action of a distribution leg that if you knew how to set up your your trades like this, and you had the understanding of this, well, your whole bias would have been short for every single trading day, and then you'd be looking for short levels to take shorts off of just selling, catching all of these moves intraday. Now, these can happen on lower time frames. I'm not saying they can't. They can absolutely happen on lower time frames, but again, I'm just here to explain you guys the picture and the whole idea of how this concept works. This is a great example on the lower time frame, right? This is actually a really, really fucking good example. You can see what happens here, right? We accumulate, we have like a little range going on here, right? We manipulate that range, right? All these stops, all these people who are trying to buy here, they get stopped out, right? In this little region over here, right? I'm going to do this one more time just to kind of give you a better example. And then we manipulate that region like this, right? And we open up on Asian, and then guess what? We end up expanding like this, right? Expanding all the way to up here, right? This is that whole AMD model that I just showed you guys about. So imagine you already knew we were in the manipulation phase, or you waited for some more confirmation. Let's say you got in somewhere in this range, in the manipulation range. Well, somewhere over here, you could have had a tight stop, right? And then you could have gotten up to damn near a freaking 10-hour trade just off this idea, and right? And it's not a coincidence that our target is going to be this Asian high right here, right? We take out that high, really good example. We hit that high. The sellers or the institutions, they want to sell more, and then they sell at this high right here and push price down like that. So you can see how these order book interactions work, how these highs and lows liquidity engineering dynamics work. So now we've talked about the whole broader scope picture of this whole liquidity cycle, AMD cycle, and how these institutions are using highs and lows to load their positions, and just how the order book works in general. But we need to now know how you can actually take advantage of this on the lower time frame using certain market structure dynamics, using technical price action to then get a good entry, like in the example I just showed you on TradingView. This is the whole basis of technical price action and market structure. It is so simple. Well, actually, you need experience on this still, but the way I'm explaining it to you, because I love you guys, it's so simple, but It is just breaks of structures and change of characters, okay? A lot of people, they have no clue on how this actually works, so I'm going to actually explain it to you in the best way, because again, I love you guys. But it's really simple. Once you have experience, you're listening to what I'm saying, and I've made a lot of videos on this in the past, guys, so make sure to go through my YouTube discography and just look at all the content I made. I have very specific videos actually talking about this fully in depth, but for the sake of this video, obviously I'm going to teach it again so you guys can understand. But this is how it works, okay? There's two concepts you need to understand. It's called a break of structure and a change of character. People get this confused so many times because they don't understand how to define each of these concepts properly and what separates a break of structure from a change of character. You've probably heard the term, market structure shifts a lot of times in your life, or they just use the term break of structure interchangeably. But breaks of structures and change of characters are completely different things, operationally. Even though they function in a similar way, they're defined differently. So let's look at a bullish structure example for a break of structure. You can see right here, right? A break of structure is when price breaks above a previous swing high, which confirms that the trend is continuing, right? Let's assume, we have this overall market trend right here. You can see in this picture. And when we actually label that, we have a swing low right here, a swing high here, swing low, swing high, etc. Okay? Now, these swing highs that are making higher highs, we need some way to confirm that price is going to continue to make a higher high and trend higher with a term, and that is what a break of structure is. As we close above these previous higher highs, that point, that line that breaks above that region, when it closes above that price action, that is called your break of structure, okay? You are able to identify the break of structure in real time once price has significantly closed above the previous swing high. So in this case, you'd be able to identify it over this this leg right here. Once this leg is formed, you would be able to confirm that this is your break of structure. Now, I like to do it in a little bit more advanced way of where I like to see the swing low being formed. So in this case, you can see right here, the swing low starts to be formed, and this is actually pretty important if you're using your fib tool, your Fibonacci tool, premium discount. We're gonna get into that a bit later, but yeah, that's kind of how it works. Simple. The line that closes above the previous swing high is going to be your break of structure line. In these examples, as you can see, as we keep making higher highs, we start closing above these other swing highs. You can see that we keep making these breaks of structures right over here. Now you're probably asking, AA bands, how do we, what's the term, or how do we characterize functionally when market structure is changing from bullish to bearish or bearish to bullish? And this is where your change of character comes in, all right? In this case, as we're making higher highs on our bullish structure, well, the market goes up and down. It goes from bullish to bearish, bearish to bullish. It happens consecutively and happens, every single day in intraday markets on every single time frame. I do want to say as well, all of this, all these concepts, this market structure is literally applied to every single time frame. Okay, so this works on literally every single 1 minute, 5 minute, 10 minute, 15 minute, whatever time frame, because the markets are fractal, and this is a term I've used multiple times. Essentially, that means what happens on the higher time frame will repeat on the lower time frame. What happens on the lower time frame will repeat on the higher time frame, and vice versa. But you can see here, we need a term to characterize the market structure shifting from bullish to bearish or bearish to bullish, and this is what a change of character is. Okay, the change of character is showing you when price breaks a swing low against the trend for the first time, which signals a reversal. Okay, you who have been watching diluted smart money concepts or diluted, ICT, call this a market structure shift, but I need you to stop using that term. It is called a change of character. As we make these, swing lows and swing highs from this picture over here, right? When we get to this high, which is also the swing high 2 in here, right? We start to then shift. Okay, we start to then shift on the in the opposite direction, and we start to make a lower high. That shift zone you can see is going to be between your swing high 3 that forms and your swing low 4. And once price closes below that swing low 3, which in this case is over here, it closes like this, that is your change of character, right? Once you close below that low, that signifies the first break in the swing low against the trend, which is called signaling the reversal and called a change of character. Very simply put, what this is saying is that price will now potentially start going in the opposite direction, making new breaks of structures in the opposite direction. Now remember, this is very rudimentary still. I go very in depth into other forms of this and how there's variations of this, because it's not perfect, but there's a lot of other concepts like internal structure, external structure, and I'm going to be talking about in the next at the end of this video on how you can actually understand these more in-depth concepts with my help. But you need to know it exists, and it is necessary to understand that other information to become profitable and actually apply this in your trading on that deeper level. But again, this is the overall example of this. Now, going back to our whole AMD example, right? When we were looking at the structure like this, right? The whole AMD cycle of where we have our accumulation, our whole manipulation, and then our whole expansion, right? This is just the first part of that expansion. We need to identify our structure, our breaks of structures, and our change of characters, vice versa, on this structure if we want to know how to enter. So what I'm going to do with you guys is I'm going to label all of the change of characters and breaks of structures in this little swing leg in this price action for you to get a gist of how it works. And we're going to go step by step, one by one, so you have an understanding of, how this works. So if I were to mark out the structure, we're going to use a tool here to make it easier for you to understand. If I were to mark out this internal structure like this, right, you're seeing all these swing highs and swing lows form. And based off our definitions of how our change of characters and breaks of structures work, well, you're going to see that on the lower time frame, because of the fractal nature, you're going to have these happen on literally every single time frame. So in this case, you can see right here when we are in our manipulation leg, you can see we have an internal, and again internal here, break of or change of character right here, right? So this is going to be our internal change of character, and you label this with I Chach. So I'm going to put a line here, and I'm going to label this the internal change of character like this. Now look what happens, right? Based off our optimal model, our theorized model that I showed you in the breakdown on the board, we're expecting price to now do this, right? And just go higher, right? Because this is what we're expecting price to do. But you're going to see in reality, it's not that simple, right? We end up actually invalidating this, and we make a lower low right here, right here we make a lower low. But since we closed bullishly on this internal structure, we made this a bullish change of character. Well, functionally, instead of having a break of structure now, since we just closed immediately and we didn't actually make a new swing low to go higher, right here we have our internal change of character in the opposite direction. And since this is that swing low that made the internal change of character from the bullish standpoint, well, you're actually going to have an internal change of character in the opposite direction right here. But this is going to be a bearish internal change of character. But then look what happens, right? Now, if you're thinking that, oh, well, we need to go down now like this more, well, look what happens. It invalidates the bearish internal change of character, and then it has a bullish internal change of character right here. So in this range, you can see you don't necessarily need to have the full cookie cutter optimized model what I showed you, but that's just kind of how the market should work in general. And we can see in reality on the lower time frame, it does get a little bit more complex. But if this is our internal change of character, and we're so certain that we're going to be bullish now, we're expecting price to then do this, make a swing low, and then go higher, right? And this is exactly what ends up happening, guys. And this is what's so beautiful. It ends up happening perfectly like this. It didn't happen on the first one, but if we're managing risk with our model, as well as we understand how the structure works, well, even though we took a loss, well, we're going to be getting a crazy high RR trade now because we understand this. So let's just recap, right? When we have this price action play out in the first place like this, all right, we're expecting off this bullish change of character to go higher like this. That ends up failing. This doesn't happen. Then on that same structure, right, we make a bearish change of character. So we're expecting either price to just be in a weird consolidation, just like a weird range of where we're waiting for this internal change of character, or we're expecting price to go down. Now, in this case, using experience, well, it's obvious you wouldn't look for price to go down. So when this gets stopped out, you wouldn't be trading at all. You'd be waiting for the next bullish internal change of character. And that actually beautifully ends up happening right, 10, 15 minutes later, right here. So now once we've done our bullish change of character again for the second time, well, then we're expecting price to do this and then end up going higher like this. And guess what? You can see it ends up playing out perfectly like this. But how do we enter now? Well, there's a lot of ways to enter, but I would just say look for a relative supply or demand level. Now, you should know how this works if you're kind of like a beginner or like intermediate, but essentially we're just marking out our levels of supply and demand. You can see that we have our levels of supply and demand in this range, and it's really simple. All you do is just wait for price to hit one of these levels. You can use a limit order or a market order, and in this case, market ends up closing at this time, but I don't want you to think that it needs to sweep the low again or whatever. It's just you can buy straight open, and that's exactly what happens. So based off this structure, if you're looking to buy at buy now, because we should, with high conviction, go higher, and we should cover our swing low right here. Why are we covering our swing low? Because price does not need to go past this low, because if it did, it would do another change of character. So if it does that, we're expecting price to then go lower again and make some subsequent breaks of structures on the internal structure, right? So we don't have to go past the swing low, and that's why you can tighten up your stop loss right at open somewhere around here, and then now you're expecting price to then, in the overall arching time frame, because of this is also in line with the AMD model that I showed you guys, we're expecting price to then expand, right? Expand like this, because we're in our manipulation phase. We know we're in our manipulation phase. And then look what ends up happening, right? If you got in right here and you're so confident in this idea because of what I taught you on the lower time frame market structure, well, bro, you could have got up to an 11-hour trade. Now, this gets a little bit more complex, not more, but way more complex with scaling in and other entries and etc. But this is the whole gist of it, right? If you use this idea of liquidity inducement theory, right, this AMD market manipulation cycle, as well as basic market structure of these ideas of change of characters and breaks of structures, you can hit trades like this. And look at that beautiful up to an 11-hour trade. If we were actually just targeting this, it would be 11.3, targeting that high. But I actually do want to, for the sake of this, talk about the next point, which is going to be the break of structure, right? Once we've established that we've closed above this previous internal internal high like this, right? This is our change in character, but this is really going to be like, if we look specifically, this whole density, I'd say like this is going to be our average next swing high. Now, if we're using the true swing high, that's going to be all the way up here like this, right? But for then to be a break of structure, we then need price to then close above this internal this high right here, and you can see, well, it does happen, right? It does happen. We close above this high over here, which is going to then be our internal break of structure, right? Or in this case, just a break of structure right here like this. And the reason we don't have a change of character is because we haven't closed below this swing low. Like, I'm gonna delete, actually I'm gonna keep it up for now. We haven't closed below this swing low or this swing low, right? So we're still holding, which means our bullish market structure is still in effect. And it's that simple. Once we close above that break of structure, well, we're just expecting our swing leg, our bearish swing leg to form. If I were to mark this out, our bearish swing leg to form, which happens over here, and then we see price go higher like this. And you could have bought anywhere on here. Like, let's say you bought here, you waited for that candle confirmation for price to hit the level, you got in somewhere around here, covering that swing low. Well, again, that's up to like a 4-hour trade. Now you can see it gets a little bit more complex, right? Because we end up retracing a little bit deep, and then we end up having that higher move like that. So if you don't manage your risk, you're gonna get stopped on the scaling. But our original trade, which is why I say, like, if you're gonna get in on these change of character entries, you always want to get in at the start, like always at the beginning, the start of kind of this whole range, to really catch those big expansionary moves. And you can see that's where we end up playing out. But this is the whole idea on breaks of structures, change of characters, market structure, and how it works and how you can take advantage of it with the AMD model, with seeing this price action play out first. So now that you've understood market structure, what the difference between a change of character is and a break of structure is, we then need to move on to the next concept, which is going to be order blocks, right? Showing you how it's operationally defined, how people use it, and how you can use it to get really good entries. But yeah, this is, so far up until the video. And guys, make sure to drop a like, make sure to sub. I hope this is helping you guys. I hope it is, because it took me years to figure this out and years to master. And this is why I'm able to bring it to you in a format which is, hopefully easily digestible and easy for you to understand. But yeah, let's continue. So you can see right here, this is where we get into order blocks, okay? So this is the anatomy of an order block and how it works. An order block is operationally defined as the last opposing candle before displacement. So in the bullish sense, it's the last red candle before an up move, and in the bearish sense, it's the last green candle before a down move. All right. Now, the reason why order blocks exist is because in the market, price will move way too fast in one direction, which leaves orders behind. Right. So it's kind of like there's an imbalance in orders. So what institutions will do is they will fill those orders, they will trade towards those orders again to have the most optimal price, right? To have another means of entering, to then fill their orders, to then move higher. When the institutions push price way too aggressively, they can't often fill their orders, right? And that leaves behind these imbalances. When price returns to that area, the remaining orders get filled, and then that pushes price in our direction that we want, or in whatever direction. So you can see right here that in this example, and why is my mouse not working? Oh, there it is. The order block here is the last bearish candle before the aggressive displacement. The displacement is going to be this whole green move over here. Now, in this case, we didn't actually return straight to the order block. In this case, this is going to be a fair value gap, an FVG, if you want to call it. It's just another form of an imbalance, but the order block or the FVG is going to be the area where price reacts. And you can see we fill that FVG. Again, it was kind of hard making this model out, and that's why it didn't work fully. I couldn't get the code right, but you can see that continuation after, right? So in this case, let's just kind of, summarize everything for the order block, right? We have that the step one, price goes down. Then we have that aggressive displacement that creates the order block right here. And then, excuse me, price will retrace back to the order block zone and then continue off that order block to then go higher. Now, in this case, we're just using this range as an example. If we were to, be in the bearish sense, this green candle would be the bearish order block. But obviously, it's a little bit more complex than that, rule wise. There's a reason we're only marking out the bullish one. But the reason why this is so important is because, excuse me, an order block is only going to be valid when it's followed by a displacement. Same thing with a fair value gap. Once we get into that, because we're covering order blocks right now. If there's no displacement, which means that there's aggression, there's volume behind the candle, that means there is no institutional imbalance or no institutional footprint, which means there's no order block or fair value gap. So again, we're going to get into the fair value gap. This is a much better example, and you can see in the same example, this is actually where price reacts off of. But let's talk about some examples now. You can see in these price examples, after we have a displacing move up to the upside, and again, we're looking at 1 minute structure because most people execute on the 1 minute structure, we're leaving behind that last red candle before an up move or the last green candle before a down move. Again, we're looking at only bullish order blocks in this case, but it's going to be right here, right? This is going to be our bullish order block. Now, as we keep going higher and higher and higher and higher, and we have these swing legs, okay, you could see we're creating order blocks right here. This is a 1 minute. You could also mark out this 1 minute order block right here. You have this one, and so on and so forth. Okay, so you can see when price comes to retest these levels, we end up moving higher. Okay, so in this case, we see that price ends up coming here. It fails through. It actually ends up working out here in this case for a scalp. It actually also works out here if you had a bigger stop. But again, the whole point of this is just to kind of give you an example and show you the gist of order blocks and how they work. We're gonna be dropping, or I'm gonna be drawing now the bearish order blocks in this case, just on the 1 minute in this example. You can see that we have a green candle before the down move right here, and after every single swing leg that you can kind of see we make. I wouldn't actually use all of this because this is relative internal structure. The only one I would be marking out is going to be either this one or this one. These are the only two I'd be marking out. It's not going to be perfect every single time, but understand that with other confirmations, with other confluences, right, and knowing which order blocks to skip, which ones to trade, that is then where you're going to figure out, that the filter is everything, right? And obviously, I help you figure out that filter later on. You can see in this one, right, the order block, it hits, right? We hit our level, and we end up having a great reaction. Now, a lot of people use this for scalps. What they do is they put limit orders at the midpoint. We're gonna get into that in the next point. Or they wait for a candle confirmation. So in this case, they're either entering off for the midpoint right here, or they're waiting for a good displacement candle like this, and then they have the stop loss above the high, and they're just going for like a negative R scalp or like a 1-to-1, 1-to-2. Like this is kind of a lot of the trades that people take. But the biggest thing I will say that makes an order block valid is, like I said, the displacement. That's just one thing I will let you guys with and leave you guys with for order blocks. We only really want to mark out the levels that have very strong volume behind them. So in this case, you can see right here off this leg, we have this volume here. Off this leg, you can see right here, we have this volume over here. And it's not a coincidence, right, that once we hit this level, right, actually we're mark out this overall level like this. Even though this is the last red candle before the up move, you can mark out the whole level because that technically is our demand, right? Our whole level. If we mark out all of this, and you can see that if we use the midpoint right here like this as a scale-in, right, you would have been in here and you would have had a stop loss. I would say like you don't want to keep it too tight. You want to give it some breathing room. So let's say, in this case, I know it's just we're making arbitrary, but I tend not to have my stops, especially on gold, like super tight like this. Like I'd say I'd have mine at like around 5 cons at this point. It would have barely missed SL, but you can see that we would have been in the trade, and this would have been a 20-hour trade, right? If just one good 20-hour trade, like you can, like, fuck everything else. If you can just get one good trade for the week, you know, for or not even for the week, for like the quarter, like every 4 months, if you can get this trade, well, you're gonna like retire yourself, right? So it's really about like once you see the opportunity present itself, because that's what trading is about. It's about, can you take advantage of the opportunity when it's presented with itself, and can you just take the trade, right? And then that's all it is. You know, you'll get a crazy high RR trade. But you've probably noticed though that I'm finally going to delete all of this to show you and give you a little bit more clarification. But usually it's after the origin of a swing leg with where the order block forms. So you can see with swing leg here, right? We have that, you know, swing leg here. So naturally, right, if we were to mark these out off these new structures, you'd have a bearish order block here, right, which is the one I showed. You have also a bullish order block here. If we zoom out as well, and just if we zoom out on the 1 minute, you would have our bullish order block here. As also, you have our bullish order block here. But in this case, what you do is you just conglomerate the levels because they overlap. You just make it one, right? But we can mark out both. And then you also have, like I said, the bullish order block or the bearish order block here, right? So we're just marking these out on the lower time frame, right? We're just marking these straight out on the lower time frame, but using our bigger picture structure, right? Even if I mark out this one beforehand, this bearish order block, let's zoom in one more time, like this, zoom in, you can see this is the, I would use this candle actually, like that, boom, look at that. See, so this is what I'm saying, guys. Once you see these order blocks and how to draw them, it's so beautiful because these are exactly where these bottom and top tick reactions are going to happen, and these ones were the most obvious, right? And you can see we had these moves up, but so far, great. I'm hoping this is making sense. So now that you've understood order blocks and the anatomy of an order block, we got to now understand what the fair value gap is. All right, and this is honestly the most important, I would say. You know, this is honestly a little bit more important than order blocks. The most important concept you can ever use in your day trading as a retail day trader over everything. A fair value gap actually shows you the real institutional imbalance left behind the displacement. Okay, now there are concepts like order flow, and that's way more advanced for this, out of the scope of this video, that you do also need to know as well. But this is for advanced traders and people who really want to understand how order flow works. But it's essentially a 3-pattern candle. There's a candle 1 right here, a candle 2, and a candle 3. And between two candles, that second candle that leaves a gap in that price because there's no wick that fills it is called your imbalance or fair value gap. And the reason these imbalances actually work and why you would enter off these imbalances is because price moved way too fast, so it leaves a real inefficiency, kind of like what I was explaining with the order block. But this is the origin of the orders, but this is showing you the inefficiency of the orders. The market wants to seek efficiency, so it will rebalance to these areas to then go higher or lower. And all you do is you take it from the low of the candle or the high of candle 1 to the low of candle 3, or just the unfilled point of where candle 2 is, right? And that's going to be your definition of a fair value gap. Now, you can see here that I have this line marked out in the middle. This is called the consequent encroachment. If you watch ICT or you've studied ICT, I hate that term. It is fucking stupid, okay? I just call it the midpoint of the region, the midpoint of the imbalance, because that's really what it is, all right? But price will often react very precisely at this area, but overall it will 100% react somewhere within the range. But again, not all fair value gaps are equal. Time and context and filtering these fair value gaps is what matters. I know exactly which imbalances to trade, which ones to ignore, as well as all the other rules that I've used over my literal 5 years of day trading, you know, damn near 6 years at this point, with multiple 6-version payouts to figure out what actually work and what doesn't work. Now, what I want to do is I want to show you the examples on the charts in general, just marking out these gaps in general before I kind of move on to the next point, which is kind of, or not the next point, but before I really kind of highlight the point of these fair value gaps, which is going to be the displacement. But you can kind of see, like, if we go back to our structure here, right? It's a 3-candle pattern. So let's say we have, you know, one green candle here, a red candle here, and then we have a candle here. This is gonna be like 1, 2, 3. If you use this one, 1, 2, 3, and then it's gonna be from the high of that previous candle to the low of, you can see right here, excuse me, of that third candle, right? And that's the gap. You can see we retest into the gap, which is also, you know, we want to refine it, right? We have our demand here, and you kind of want to refine these levels to get the actual precise level of where price is going to go, and then, you know, we have that reaction. But moving forward, right? using our whole idea of our market structure and our breaks of structures, well, you can see right here, even though we have our order blocks in this range over here, well, we have our fair value gap right here. This is going to be the actual point of where price wants to actually react off of, because this is the real market inefficiency. And what people do is, again, they either will put limit orders, or what they will do is they will use actual candle confirmations to take the trade. But again, the whole point of this is I just want to show you these fair value gaps, right? If I were just to mark them out, and yeah, just kind of show them out to you in this case. So you can see right here we have one right here, right? You could also say we have one right here like this, and then there's a bunch of smaller ones here, 1 2 3 4, and then we have one right here, and then one right here like this, and yeah, that's pretty much all it is. We have all these imbalances. We have a couple more actually, but I'm just trying to give you the gist of it, right? On how to mark these out. It's just a 3 candle pattern of where you have one candle, right, that makes the initial candle. The second candle is a candle that has a big expansion like this, and the third candle is going to be I fucked that up kind of. The third candle is going to be a candle that has a bottom wick like this, and still is in the same direction, and our fair value gap is going to be in the range between the high of the last candle and the low of the third candle, and it's going to be like this, and that's going to be the midpoint, right, like this. So that's kind of what we want to see it as. But like I said, based off this example, the biggest thing here is going to be your displacement, right? You can have a shit ton of imbalances like I showed you, but if those imbalances do not have displacement, they don't have actual volume behind them, that isn't actually going to be a fair value gap, right? And you're going to see that in smaller price action on the 1 minute time frame. That's why the 1 minute's not really the best sometimes for marking out and just looking straight at price action. But you can see if you have small bodies and you have long wicks relative to that body, overlapping candles, no directional commitment, like you're not going to see any fair value gaps. But they're also in certain cases in the real market, you will also see actual gaps, but that doesn't mean those gaps are valid, right? There's no institutional footprint here. There's no retail going back and forth. There's no inefficiencies for the algorithms and the market makers, the people who control the market to take advantage of. No order blocks, nothing, right? You need to see something like this. This is exactly what displacement is. You have large bodies, tiny wicks, and those gaps are very obvious to see. And this is aggressive. It is directional. There's minimal overlap between the candles, which creates the fair value gap and validates the order blocks, right? This is the institutional capital that is moving price in a certain direction, right? The institutional footprint, you could say, that confirms the displacement candles. And yeah, you can see this is what it looks like. The key here, again, for the 5th millionth time, is the displacement. This is what connects everything, like the glue of this concept. Let's go back to our chart here, and you can kind of obviously, you can see the difference, right? Like, would you mark out this small imbalance, let's say, in this price action like this one, right? Like this one, actually, this ends up, this is probably not the best example because it ends up reacting. Or would you actually mark out something with real displacement behind it? Like, for example, this one, right? If we mark out this one and we mark out this one, you can see clearly that this one ends up having that small scalp. You always want to look at the bigger picture. So for example, these imbalances would have been the valid ones, right? In my opinion, these imbalances would have also been the valid ones right here. You could also mark out these imbalances because I would also say that these are valid. You get the idea. Same thing here, and actually I covered this, right? We have this imbalance right here, right, that we end up filling and we end up going off of, but all these little ones, they don't really matter, but this is the main one. You can see like this. So you need that displacement to mark these out. And there are indicators that can do this for you. I actually do have an indicator for my students that does this automatically. With my criteria as well. But yeah, that's the whole gist of order of fair value gaps. All right, so now you've understood basically the whole cycle on, what I've taught you for liquidity theory, for our market structure, our breaks of structures, our change of characters, as well as our fair value gaps and order blocks, the whole smart money concept ICT package, right? This is the full sequence on how every single concept connects into one singular playbook. I'm going to literally give you the framework and give you the steps. We wait for the liquidity, we wait for the sweep or the manipulation of that liquidity, whether that be an AMD model or just a higher low being made. You then spot the displacements left by the fair value gaps or the order block, right, as well as a confirmation with our break of structure or our change of character. then you confirm it with that, the breaker structure of the chaining character. You enter in at the order block or the fair value gap, and then you just target some opposing liquidity, which is going to be a swing high or swing low. It's that simple. But let's kind of go into it specifically, right? You first find the swing highs and the swing lows, right? This is where the stops are resting. You know this based off the whole idea of what I showed you of, institutions, engineering this liquidity to fill their orders. You have the buy side and the sell side, all right? Then you wait for price to run into that area, right, where those stops are, those swing highs or the swing lows. And then you first, I would actually, kind of switch this, but because the displacement and the confirmation of the chaining character, the breaker structure, they kind of happen at the same time or one by one. But we know the displacement is going to be your large bodied candles with tiny wicks that go away from the sweep, which is going to create your fair value gaps, which are going to be your market inefficiencies, and then your order blocks, right? And then it's going to validate with your order blocks, but you get the point. And then that's when you're also going to have your chaining character as well as your breaker structure, right? The structure shift against the previous trend in direction, or the continuation, maybe because there was already some type of changing character on some higher time frame or something like that, but you get my point. And then all you're simply doing is you're entering in back into the fair value gap or the order block, and then you're entering in based off the next slide I'm going to show you, which is premium and discount. You're either entering in a discounted area or a premium area, whether you're buying or selling, and you just target the opposing liquidity, right? Which is going to be the opposite opposing swing high or swing low. This could be also a session high or swing high or swing low, like London, Asian session, whatever, New York session. And then this is the whole cycle. It literally just repeats, guys. It's literally this framework. So you can take a screenshot of this, but it's this simple. But you got to understand though that no concept is going to work by itself. All right, liquidity is going to show you where, but the displacement is going to tell you when. All right, and the structure tells you the direction on how it gets there, right? The vector, the fair value gaps, and the order blocks are going to give you the entry, and the opposing liquidity is going to give you the target. This is the full playbook, no bullshit. Now, again, I do want to reiterate that the two variations you're going to have is going to be like your accumulation, and then your manipulation of that accumulation, or just your normal swing highs and swing lows. Now, you might also say like, oh, AA bands, like, how do I know which swing highs and swing lows are more probable in liquidity? And to that, I say, well, usually your higher time frame swing highs and swing lows are going to be your more important and more valid swing highs and swing lows. But there are some other couple of criteria to filter that out. Now, we need to talk about premium versus discount and the OTE zone. This is honestly the like the most important of ICT theory and smart money concepts theory. But the whole idea is that if you're an institution, right, like, sure, you want to buy and sell, to fill your orders, but you want to figure out where to buy and sell. Like, how do you figure out in respect to the actual price action that's in your face, where to optimally buy and where to optimally sell? And this is the idea of premium and discount. If you are above this area of the 50% of a range, that is called your premium, okay? The actual 50% line is going to be called your equilibrium. But if you're below that, that is called your discounts. And this is going to be relative to a swing high or a swing low. You're essentially measuring the area, right, the region of a swing high and swing low to figure out optimally where price should move from in a range. So we take our tool, we mark it from our swing low to our swing high, and we have our percentage fib multiples of this tool. And the OTE zone is going to be anywhere from 62 to 79%, okay? This is the overall zone you want to mark out. Now, I actually will say, don't just mark out a line, like, have this zone actually marked out, because price will react off that area and literally rocket in your direction like 95% of the time. But this is the whole thing. You want to either buy in a discount below the 50%, which is going to, and ideally going to be in the OTE zone, or you want to sell in premium, which is above 50%. All right. But you never want to either buy in premium or sell in discount. Now, this one rule will filter out all bad trades, especially against volatility and whatnot. And I will say it does get a little bit more complex if you're trading internal structure, but if you're kind of zoomed out, you'll get the whole picture of this. But this OTE is called optimal trade entry zone. And this is literally what will kind of make and breaks the whole idea of smart money and ICT trading. But this is great and all, but the final piece of the puzzle is going to be time and kill zones, right? And this is the missing piece that most people just completely ignore. So you guys know in a trading day, if you're trading futures or CFDs, you have a 24-hour trading day. Most smart money concept trading ignores time completely, and you can use it to actually create a model for yourself and use it for figuring out these high probability areas. Based off your time zone, this is going to be a little bit different, but this is the whole kind of theory behind it. Now, I know this is EST, but it's really CST, and there are actually indicators that mark this out, but essentially, what you're looking at is areas of where there's volume going on, where there's activity going on, where there's when the institutions actually want to push price in a certain direction. And the whole theory is that I'm gonna just mark this out or tell you guys in the simplest way is that in your London Open is you're really going to have your manipulation happen. So in Asian, you have the accumulation in Asian session, the Asian range. The London Open manipulates that Asian range, and then in New York, it usually expands that. Now, it does get more complicated than this, and in between those times, you have those dead zones. But understand, right, that time is important, and I do encourage yourself to build a model around that and test the data, but it doesn't need to necessarily be, especially on the higher time frame, like that precise, right? You can have, like I said, like you can see right here, we have our manipulation form in the London session, and then in the end of New York, we have that manipulation, and then at the start of Asian, we have that expansion. So yes, time is powerful, but this is the whole idea. I'm just trying to show you guys the basis of ICT and like what he teaches and kind of how you can understand a little bit better. Now again, you can have your fib tool. I have my fib tool literally right here as like the first one, but this is how I have my fib tool. Again, it's based off a couple other things, but really that 62% to 79% in this range right here is going to be your area for optimal trade entries. And well, it's not a surprise that when you take your fib tool out and you take it from a swing low to a swing high, or a swing high to swing low, but in this case we're going to use swing high to swing low, well, what happens, right? In that 62% area, which I just I'll mark out that region from here to here. Well, it's not a surprise that you can see that this is where price ends up reacting and then having that move up. So let's say you're combining all these concepts together. It's literally that simple of entering in a trade, based off a break of structure or change of character, in based off everything I've taught you with our AMD model in this region over here, and then catching that high probability trade. Now, let's say you got in based off what I taught you of that order block and that fair value gap over here, but let's say you would take it a layer deeper and using the concept that I just taught you of breaks of structure and change of characters. Well, you might be waiting for price to hit a certain area, and then you might be waiting for a subsequent change of character with a break of structure then to enter in on that. So let's say you wait for that change of character, right, which happens over here, and then you wait for maybe another break of structure, which happens over here, right, like this, and then then you enter off that internal structure, wait for another retrace off that internal structure from this swing high to the swing low over here, and you enter in at that that OTE area, which is going to be from 62 to 78, which is going to be your area to enter in. And well, look what happens, right? You enter in over here, stop loss covering the low, right? Like this, and boom, that's your second entry to enter in on the trade, and then price ends up just rocketing for 16R. So let's say you got into both entries, and you can make a model around this however you want. Like this is just crazy. Like let's say you just enter off the change of character right here, just wait for the retrace or whatever. Like in every single one of these scenarios, you could have got a 16R trade on this. And off any given range, you can see, like, you can take your fib tool out from any given range and just mark it out, right? Like, so if you're going to sell, well, where would be the best point to sell? The best point to sell would be in this range over here. But if we overlook and we look over here, well, we don't see other confirmations. We don't have our order blocks. You don't have our fair value guys. Like, there's nothing over here. So realistically, the only trade would be even deeper, which is going to be our extreme area of supply, which is going to be our order block. And well, that's where price reacts. But you want to be using this fib tool to analyze your structure in both single scenarios, like almost 24/7, guys. And based on what I taught you on these kill zones, you can look for the specific setup for specific times. And these kill zones are important for you, especially if you have a 9-to-5 job and you can't be in the charts 24/7. You're looking for these patterns, these price action patterns to occur at a specific time. Now, the reality is, I will say, is that this is not going to happen every single day. Okay, guys, and I hate how people lie and they say that, oh, this happens every single day. No, it does not happen every single day. The reality is you might have maybe 1 or 2 of these setups per month, but then on these setups, on these high probability setups, like I showed you, that is where you get the most high risk to reward. So I urge you guys, right? First, number one, when developing a trading strategy and developing a trading system using this methodology that I'm teaching you is, number one is you need to figure out your responsibilities. I don't know who you are. I'm talking to you behind a YouTube video. You're not one of my students. So it's like, I can't make a plan, a custom made plan for you guys to trade because you're not one of my students. So ask yourself this though, what are my responsibilities, right? Where do I have to be? What do I have to do? And then when you have that all blocked out and marked out, first figure out like what time from what time can you trade, and can you actually be seated down, be in a spot, with your computer, and you're able to actually trade. So now you kind of understand the whole basis on ICT, right? You have the concepts, you have the understanding, you have the idea on how to enter in, and now you're basically good. What I do want to talk about though is some common mistakes, and kind of get into the final part of this video of that a lot of people make when getting into ICT trading and smart money concepts. What you have to understand is, like, when you're watching like an ICT video or you're trading ICT, right? ICT is not teaching you indicators, right? He's teaching you how to read price action the way an institution would, and that's what I'm teaching you, right? A better, more explained version of smart money concepts in ICT. But understand, these concepts are not magic. They're high probability, but they're not magic. You still need to test these ideas over multiple trades with a whole other slew of rules and understanding of price. This is just, what I've taught you is a framework for understanding order flow and liquidity on a beginner, retail level. This goes way, way, way more in depth that I'm obviously can't show you for YouTube because, well, I have a program and I have value in my program. The traders who are making money day trading, the profitable day traders who you see, day in and day out, who are trading with SMC, smart money concepts, they're using it as a framework to build a system for themselves. They're just not memorizing these concepts blindly, and then they're testing it, which is why they're having success. They're building a repeatable system around this framework that I've taught you. So now you know every smart money concept and IC concept in its full form. Genuinely, this is not gate kept. This is, you've learned this all in this video, and this hopefully this video is 40 minutes long. But you've learned liquidity. And actually, I'm gonna get my handy dandy. Where is this handy dandy tool? My handy dandy tool for you guys. Show you, like, you've learned everything, right? You've learned liquidity. You've learned the AMD cycle, market structure, breaks of structure, chain of characters, order blocks, fair value gaps, all of this, displacement, premium versus discount, OTs, kill zones, and times. But you guys know I have an actual strategy, an actual model on how I trade. It's back tested over multiple trades, over 1,000, I'd say at this point. It took me all this time to verify my system, verify my specific edge built on these concepts actually has an edge. The real skill isn't knowing how an order block is made. It's not knowing what an order block is. It's knowing how to use an order block, knowing which one to trade, which one to enter, how to manage it, and then having the discipline to follow through, of your model, of your system when you're like 4 hours deep in on a random Tuesday, having access to someone who can help you with this. The concepts I'm teaching you are free, right? The execution, the accountability, the feedback though on your specific trades, that's what's going to separate somebody from someone who understands smart money concepts and from someone who's actually profitable with it, right? Like, you can understand these concepts, but it doesn't mean you're going to be profitable with it. Build the system, back test it, manage the risk, execute it live, and then you get feedback. But the biggest thing is feedback. You need someone who's had real success to help you with this and handhold you. And that is going to lead you to consistent profitability. Having a verified statistical edge with a repeatable system, risk management, emotional discipline, all of the above. You're going to have all of this. Now, guys, we've reached the end of the video. It took me a long time to make this. So listen, man, if this made sense to you, if this video made smart money concepts click for you and you really learned something, it doesn't hurt to just drop a sub and a like, man. I'd really genuinely appreciate it, guys. You guys know me. I'm building the most honest trading education YouTube channel. I've been making content for a minute now, but I'm really trying to focus on these long form videos to help you become profitable. And listen, if you're actually ready to go deeper, build an actual system with more concept, with more understanding, back test it and trade it live with my guidance, with real guidance, you can go ahead and apply for my alpha trading mentorship in the description. I go really in depth into what's in my program and how you can benefit from it. But again, that's only for people who are willing to take this to the next level and really, really accelerate their growth. And with that, I hope you enjoyed the video. Drop a comment down below as well saying what part of the video was your favorite, what part made the most sense to you, what part you might want some more clarification on so I can make some more content for you guys. And yeah, I appreciate your guys' support. Thank you, take care, and see you in the next video.